Oh my God. If you're seeing this right now, you already know why we're here. It happened. Silver didn't just tap $70. It ripped straight through it and printed a fresh all-time high at $71.11 per ounce in the US market. That's right, 71.11. The unbreakable wall. The level everyone said the banks would defend with every trick they had their so-called kill switch. It didn't work. It failed completely. Ladies and gentlemen, Asian guy here. Today is one of those landmark days in the silver market that people will be talking about for years. December 23rd, 2025. The day silver proved once and for all that physical demand runs the show. Paper games are cracking, and the squeeze we've been waiting on isn't coming soon. It's here. If you're loaded up in physical silver miners or even futures, congrats, this is your moment. If you've been sitting on the sidelines, lock in, because what happened today changes the entire landscape. We're going to walk through it all. The exact price action, how we reached 71.11, why we got that pullback, the geopolitical sparks, the inventory drains, and most importantly, why the bank's desperate attempts to cap this move just blew up in their faces. Let's start with the numbers because they're ridiculous. As of December 23rd, 2025, spot silver surged to an intraday peak of $71.11 per ounce. First time ever silver at 71. Not a quick tap, not a fake out, an actual breakout. Live charts caught it perfectly, bids pressing up near 70.64, offers stacked above, and that high stamped right at 71.11. Some feeds showed closes around 70.96, up more than 2% on the day. Headlines were everywhere, silver crossing the $70 milestone for the first time and extending a record run. Reports also pointed to the same theme, fresh highs driven by safe haven demand. And this wasn't some random overnight spike. Silver has been building all year. Year to date up roughly 137 to 140%. That's the strongest annual performance since the late 1970s into the early 1980s when silver went completely parabolic. We're talking a move from under $30 early in 2025 to 71 now. That's more than doubling in 12 months. And December alone, over 35% in a single month. The chart looks like pure heat, higher highs, higher lows, and that curve bending upward faster. Now zoom in on today specifically. Silver opened strong around $68.96 to $69. It climbed steadily through the European session as geopolitical headlines hit. Then it ignited during US hours. By midday we were hovering right under 70. Then boom, 71.11. People on X were losing it. Posts screaming silver at 71, and banks in panic mode started going viral. Volume picked up even with the holidays in the background. March futures were strong too, with some reports showing a close around 71.4, up over 3.5%. And then came the pullback. Prices slipped back toward the 69 to 70 area late in the session. Why simple classic profit taking? After a vertical spike like that, traders take chips off the table, especially in thin holiday trading where liquidity is lighter and moves can get exaggerated fast. A bit of dollar strength crept back in DXY, up about 0.3%, and that added some selling pressure. But this isn't a reversal. This is consolidation, the market taking a breath after running nearly $18 in under a month off the November lows. In a bull market this overheated, that's normal. And the key detail, futures equivalent closes stayed above $70. The breakout still stands. The line in the sand is still behind us. Put this move in perspective for a second. The old all-time high back in 1980 was around $50 nominal, which is well over $150 in today's money after inflation. In 2011, the peak was 48.70. For decades, silver lived in the 20s and 30s while gold took off. But 2025 flipped the script. We cleared 50, then 60, then it sprinted through 65, and now we're staring at 71. And the pace of the move, it's textbook parabolic. The time between $10 steps is shrinking fast. The jump from 60 to 70 took days, not months. And the banks, they threw everything at it. Mid-December margin hikes, boosting requirements from around 9.5% toward 15%, supposedly to manage volatility. Spoofing chatter, big fake sell walls meant to spook buyers. None of it mattered, 71.11 printed anyway. That whole kill switch idea, emergency rules, liquidation-only moves, forced measures to stop a squeeze didn't save them. It failed hard because physical demand steamrolled the paper game. Why did this happen? Because this rally isn't just speculative heat. Its fundamentals turned up to maximum. Let's talk about the triggers one by one, because if you understand why today happened, you'll understand what could come next. Geopolitics lit the fuse, and I mean really lit it. We're talking about sanctions escalating sharply around Venezuelan tankers, not just warnings, but real enforcement that disrupts oil flows. This isn't theoretical. Ships get detained, insurance gets pulled, payment rails get frozen. Venezuela's already fragile oil system is under direct pressure. Then add the cyber angle, a confirmed cyber attack on PDVSA. The state oil company systems down operations disrupted production, potentially affected for weeks or longer. So why does that matter for silver? Because energy disruption equals inflation risk, oil markets get jumpy, supply chains start pricing delays, and manufacturing costs climb. And the moment energy security becomes a question mark, money runs to hard assets. Silver has always been a strong inflation hedge alongside gold, but it has an extra punch because it's also an industrial necessity. When oil risk rises and markets get nervous, silver catches a bid. Safe haven buying hit today, and it's not just retail, think institutional positioning, sovereign-style allocations, and even quiet reserve building in the background. But that's only the immediate spark. The bigger backdrop is even more important. We're in a world where geopolitical risk is rising on multiple fronts. At the same time, US-China tensions haven't cooled, the Middle East stays fragile, Russia-Ukraine remains unresolved, and Taiwan tensions keep simmering. BRICS expansion keeps challenging dollar dominance, and de-dollarization is pushing more trade settlement in yuan rupees, and even gold threads that pull capital toward tangible assets. At $71, silver still looks cheap versus gold when you compare historical ratios and industrial demand. Then you layer on the Federal Reserve signals. Today we got fresh remarks from Governor Christopher Waller, historically hawkish, talking about more room to ease in 2026. Markets didn't waste a second. Traders quickly priced in 2 rate cuts for next year. The December FOMC dot plot was already hinting that way, and Waller's tone stamped the shift. And here's why that matters. Lower rates reduce the opportunity cost of holding non-yielding assets like silver and gold. The dollar softened earlier in the session, not a meltdown, just enough weakness to give metals a tailwind. When you combine easing rate expectations with renewed inflation anxiety from geopolitical energy risks, you get the perfect setup for precious metals. That's the storm. Media headlines summed it up as rate cut bets plus geopolitics, a perfect mix. But even that framing doesn't fully capture the real engine underneath this rally, supply and demand math reaching a breaking point. We're now in the 5th consecutive year of structural silver deficits, 5 straight years where the world has been using more silver than it produces. Depending on which industry tracking estimates you follow, annual shortfalls range from roughly 95 million ounces to about 149 million ounces. For 2025, many projections cluster around a deficit near 118 to 149 million ounces. People hear deficit and shrug. They assume someone will find more silver or recycling will close the gap. But here's the reality. Mine output is basically flat. Global mine supply has been trapped in a narrow range around 800 to 850 million ounces per year for multiple years. Why is supply so stubborn? Because silver is mostly a byproduct. Roughly 70% comes out of lead, zinc, copper, and gold operations. You don't just decide to ramp silver production on its own. You need the primary metals to justify more mining. Those markets face capital spending hurdles, permitting delays and ESG pressures, so new silver supply doesn't show up quickly. New mines take time, often 10 to 15 years from discovery to real production, so there's no cavalry arriving in 2026 or 2027. The projects that could actually move the needle are being planned now for the early 2030s, while existing operations are gradually depleting. Mexico, the largest producer at roughly 200 to 230 million ounces per year, faces regulatory uncertainty, labor friction, and rising resource nationalism pressure. Peru, a close second, has its own challenges, and there's no giant new discovery waiting on the sidelines to flood the market. Recycling does help, but it has limits. Industrial recycling, pulling silver from electronics, photovoltaic gear, and medical equipment adds maybe 150 to 200 million ounces a year. The problem is that a lot of industrial silver is effectively consumed, scattered in tiny amounts per unit, making recovery uneconomic, so recycling can't erase a structural deficit overnight. Solar panels are a perfect example. Each panel uses a tiny amount of silver, and the end-of-life recycling system is still catching up. On top of that, when prices rise, people hoard fewer holders, want to sell old silver when they expect higher prices ahead. So supply stays pinned roughly 1 billion to 100 million ounces from mining plus recycling, while demand runs closer to 100 million to 300 million ounces. That shortfall has to come from somewhere, so it comes out of above-ground stockpiles, vault inventories, ETFs, and strategic reserves, and those inventories are getting drawn down. Now let's talk industrial demand, because this is what makes 2025 fundamentally different from 2011 or 1980. Back then, silver spikes were mostly investment and speculation. This time, industry is driving the bus, and that demand is sticky. Manufacturers need silver, even when the price climbs at least up to a point. Solar PV is the biggest industrial use for 2025. Solar demand is estimated around 260 to 300 million ounces, up from roughly 197 to 232 million ounces in 2024. Installations are exploding across China, the United States, Europe, and India, and silver is critical for conductive paste in solar cells. Yes, there's been thrifting cutting silver per cell by about 10 to 20%, but deployment is growing faster than thrifting can offset. Newer high-efficiency designs like TOPCon and HJT can use 30 to 50% more silver per cell, so as the industry upgrades, silver intensity can rise. EVs are the next big driver. Each electric vehicle uses about 25 to 50 grams of silver, which adds up fast when you multiply it by millions of cars. Estimates for EV-related silver demand in 2025 land around 50 to 100 million ounces when you include vehicles plus charging. And every charger uses silver too, roughly 15 to 30 grams in contacts and wiring, so with tens of millions of chargers needed globally through 2030, that demand is baked into the system. Then there's the AI and data center surge, the wild card almost nobody priced in a couple of years ago. AI servers and GPU clusters need dense power delivery and serious thermal management, and silver shows up in conductors, connectors, and thermal materials. One AI rack can use 2 to 3 times the silver of a standard rack, and hyperscalers are building capacity at insane speed. Estimates put AI data center silver demand around 5 to 15 million ounces in 2025, with projections pointing to 50 million ounces or more by 2030. That's a massive step up in a short window. And that's on top of the everyday demand that doesn't go away. Electronics, phones, laptops, appliances, medical antimicrobial uses, imaging, industrial catalysts, mirrors, and bearings steady to rising. Industrial demand is roughly 55 to 60% of total silver consumption, and it isn't optional. Battery makers can't scale certain chemistries without silver, EV producers can't build vehicles without it, and solar manufacturers can't hit efficiency targets without it. That's why the move to 71.11 isn't just a hype spike, it's a repricing, as the market recognizes industrial demand can overwhelm dependable new supply. And then investment demand stacks on top. That brings us to investment flows, ETFs, and physical. Globally, silver ETFs hold about 1,100 million to 1,200 million ounces. The giants include SLV at roughly 500 million ounces and PSLV above 200 million ounces, plus other funds. In the first half of 2025, ETFs saw net inflows around 95 million ounces, and that matters because funds have to source and vault physical metal. If an ETF adds 10 million ounces, that's 10 million ounces effectively removed from the open market. And this isn't just retail chasing a headline. Reports point to major capital coming in pension-style money, hedge funds positioning for higher prices, and investors hedging inflation risk. PSLV, often favored because it's fully allocated and redeemable, crossed around $10 billion in net asset value by mid-October and kept climbing. These inflows matter because their sticky ETFs don't flip metal in and out daily, and once it's vaulted, it tends to stay locked up. On the physical side, coins and bars, the picture is mixed but improving. US Mint data showed Silver Eagle sales down about 30% in 2024 versus 2023, largely because premiums were high and many buyers were already positioned. But in Q4 of 2025, demand picked up again. Retail premiums have been holding around $2 to $10 over spot, sometimes more for popular products. Dealers have reported tight supply on certain items, longer wait times, and strong buying from both new entrants chasing the move and experienced stackers buying dips. Globally, coin and bar demand is expected to rise about 7% in 2025 after a steep drop the year before. The point is simple: as prices break records and headlines spread, retail attention comes back fast, and we're still early in that curve. Now here's where it gets critical: what's happening inside the COMEX vault system. COMEX inventories split into registered and eligible. Registered is metal set aside and ready for delivery against futures contracts. Eligible is metal stored in the vaults, but not committed for delivery, privately owned, and the owner can choose to convert it to registered, but doesn't have to. For years, the system relied on a big cushion of eligible silver that could be registered if deliveries spiked. The logic was simple: if the market tightens, eligible holders register metal to capture the premium. But that's not what's happening. In fact, we're seeing the opposite. Recent vault updates, especially in the last 2 weeks leading into December 23, 2025, show more than 3 million ounces pulled out of eligible inventories. That's basically owners saying, I want my metal out of the system. No conversion to registered, no trading games, just remove it. And registered stocks, they're basically stuck. No meaningful inflows. Whatever is registered is staying there, but fresh metal isn't showing up to replace what's leaving through withdrawals and deliveries. Here are the rough numbers. Around mid-year 2025, total COMEX silver stocks registered plus eligible sat near 460 million ounces. By late December, it's closer to 450 million ounces, about a 10 million ounce net drop in 6 months. Not massive as a percentage, but the direction matters. And inside that, total eligible has absorbed most of the damage, down roughly 15 to 20 million ounces. Registered has been relatively steady, even ticking up slightly when some eligible gets converted. But here's the real punchline: in just 2 weeks, more than 3 million ounces left eligible with almost nothing coming in. If that pace continues, you're talking about a drain that could approach 50 million ounces over a year. And the craziest part, this is happening at all-time highs. Normally, higher prices bring supply out, people sell into strength, but not this time. Higher prices are doing the opposite. They're making holders tighten their grip. Either they expect higher prices ahead, or they don't trust the system to perform if a real squeeze hits. So why pull metal from eligible? Different reasons, same message. This isn't over, and I want my silver under my control. First, strong hands are accumulating family offices, sovereign-style buyers, and even industrial players trying to secure supply before it gets uglier. They see the deficit math, the industrial demand curve, and the geopolitical risk, and instead of paper exposure, they're taking delivery real bars stored in allocated vaults they control. Second, there's distrust of the exchange rules in a crisis. History matters here. In 1980, after the Hunt brothers squeeze drove silver to around $50, the exchange shifted to liquidation only, and the price collapsed. In 2011, margin hikes helped choke the rally near 48.70. The fear, fair or not, is that if silver truly squeezes and threatens big shorts, the rules change to protect the system. If you're sitting on eligible metal, why take that risk? You pull it now. Third, premiums. Physical silver is selling over paper retail coins and bars, often $2 to $10 above spot, sometimes more for high-demand items. If you're a dealer or refiner holding eligible bars, you can pull them out, process them into retail products, and capture that premium instead of leaving metal sitting in the vault system. Why leave metal sitting in eligible earning nothing when you can capture real-world premiums? And there's a fourth factor too, rehypothecation and leasing risk. Eligible silver isn't always idle. It can be lent out, used as collateral, and shifted around. In periods of volatility, owners want clarity and control. They don't want their metal stuck in a system they can't fully see into. The result is simple. Eligible inventories keep draining, and registered stocks aren't refilling fast enough. So what happens if this trend continues? If eligible keeps falling while registered stays flat, or worse, starts dropping, the pool of deliverable silver shrinks. COMEX open interest is enormous, hundreds of thousands of futures contracts, each tied to 5,000 ounces. Most of those contracts settle in cash, but what if even 5% stand for delivery, or 10%? That's millions of ounces of demand facing a registered stock base that might only be 100 to 150 million ounces. In a normal market, that's manageable. Eligible converts, new metal shows up, and the system adjusts. But if owners refuse to convert and no fresh supply comes in, you don't get a normal squeeze, you get a structural squeeze. That's where there simply isn't enough physical metal to deliver, forcing cash settlement, emergency rule changes, or something more disruptive. The banks know this. The commercials know this. That's why they reached for every lever today: margin hikes, spoofing, and volatility controls. And it still didn't stop price from tagging 71.11. Why didn't it work? Because this time the demand isn't coming from leveraged speculators. It's coming from physical buyers, industrial users, and sovereign-scale players, and you can't margin call a factory that needs silver to keep operating. Now, zoom out, because COMEX isn't the whole world. Shanghai matters. The Shanghai Gold Exchange is the center of physical silver trading in Asia, and Chinese demand has been huge, both industrial and investment. China produces the bulk of the world's solar panels and a massive share of EVs, while households buy silver for inflation protection and wealth preservation. Reports show SGE silver inventories trending lower, even hitting multi-year lows in some cases, because China is consuming more than it brings in, and domestic output isn't closing the gap. There's also the quiet accumulation angle. Official data shows rising gold reserves, and while silver data is opaque, persistent rumors point in the same direction. When Shanghai inventories are tight and COMEX stocks are shrinking, the global pool of available silver contracts fast. In theory, arbitrage should balance this. If silver trades higher in Shanghai than in London or New York, metal should flow east. But in practice, shipping takes time, premiums must be wide enough, and in a tight market, traders hesitate to move metal they may not be able to replace. The outcome is fragmentation: one price in New York, another in London, another in Shanghai, and yet another for physical coins and bars. Those prices should track closely, but under stress they don't, and the early warning signs are already here: rising physical premiums, delivery delays, and accelerating vault withdrawals. These are the fingerprints of a market under pressure. Now let's hit the elephant in the room: JP Morgan and the long-running manipulation narrative. For years, decades, the silver crowd has pointed at JP Morgan as the big short keeping prices capped. And there's a hard fact people cite. JP Morgan paid about $920 million in penalties in 2020, tied to spoofing in precious metals markets. Traders admitted to placing deceptive orders, and that part isn't theory, it's on the record. But here's where it gets interesting. Over the last few years, a different story has circulated. JP Morgan may have flipped. Instead of being heavily short, they've reportedly been stacking physical silver, with some estimates putting it anywhere from 500 million to 750 million ounces. The claim is that it's held in their own vault structure, rather than sitting as COMEX-eligible stock. If that's even close to accurate, that's over 500 million ounces, making them one of the biggest private holders on the planet. Why would they flip? Because they ran the numbers, a structural deficit doesn't go away overnight, and industrial demand is sticky. Trying to sit on the price with shorts becomes a losing trade over time, so the smarter play is to cover and accumulate physical at lower prices, think the 20s and 30s. Then you ride the upside when the cycle turns, and their tone has reportedly shifted too, with more constructive calls tied to supply tightness and industrial demand. Does that mean manipulation is gone? No spoofing headline games and algorithmic sell walls can still show up. But the scale and incentives change if a major player is net long physical, because a huge physical pile doesn't exactly motivate you to nuke the price. You might still try to manage volatility to accumulate, but your endgame isn't the same as a committed short. And that's part of why today mattered. The kill switch mentality failed because the big players don't appear perfectly aligned on the short side anymore. Some are long, some are neutral, and the concentrated cap, the move effort, looks weaker, so you can get a print like 71.11 even with every tool being used. Physical demand is starting to overpower the paper structure, and that shifts the whole battlefield. Now, what comes next? Because 71 is a milestone, not the finish line, and a lot of forecasts for 2026 are clustering higher. You've got bulls calling for $100 on easier policy and persistent inflation, others tying upside to an AI-driven electrification cycle, and more conservative outlooks still seeing mid-70s by end of 2026 on rate cut expectations. A softer dollar and tight supply. More conservative than the big bulls, sure, but still meaningful upside from here. And you've also got major bank-style targets creeping higher, with some institutions pointing to $100 silver by mid-2026 on the back of supply tightness and accelerating industrial demand. These aren't random internet takes. This is mainstream research drifting in the same direction. Surveys of traders and analysts for 2026 often cluster around the 80 to 90 zone on average with a wide spread. Some see 60 if a recession smashes industrial demand, while others see 150 if a true squeeze ignites. And then you've got the ultra bulls comparing today's setup to 1980 silver at around $50 nominal back then, well above $150 in inflation-adjusted terms today. They argue a real mania could push silver into the 150 to 200 range. So which outcome is most likely? Nobody can know for sure. Markets are probabilities, not guarantees. But the underlying setup still leans bullish. The deficit isn't disappearing. Industrial demand is largely locked in, and you can't just unbuild EV factories or solar supply chains. Investment demand also tends to ramp late, right when headlines wake up the mainstream. Meanwhile, physical supply stays tight and looks like it's getting tighter. Here's a reasonable base case framework. $75 becomes the next major level to watch. If we test it in Q1 of 2026 and break it cleanly with real volume, a fast run into 85 to 90 is realistic. From there, 100 comes into play around mid-year. Will there be pullbacks? Absolutely, but the primary trend remains higher. Bull case, we slice through 75 and never give it back 90 in Q1, 120 by mid-year, and 150 if a squeeze dynamic triggers. That path happens if industrial demand surprises higher, EV adoption stays hot, AI build-outs accelerate, or delivery stress on major exchanges sparks panic buying. Bear case growth slows hard. A recession or deep slowdown cuts industrial demand by roughly 10 to 15%. Investment interest fades, and silver drifts back towards 60 to 65, chopping sideways for months. Even then, the deficit likely shrinks rather than disappears, and any recovery cycle would reapply upward pressure. And yes, the risks are real. A stronger dollar can cap metals. If the Fed pauses, cuts, or hints at renewed tightening because inflation reaccelerates, or the labor market stays too hot, the dollar can rip. You saw a small version of it today. DXY up about 0.3%, silver backed off the highs. If the dollar index runs higher, silver could consolidate or dip into the mid-60s. Economic slowdown is another risk. EV sales can cool if consumers pull back. Solar projects can delay if financing tightens or subsidies change, and data center expansion can pause if the AI narrative softens. A 10% hit to industrial demand could remove roughly 100 million ounces of consumption, narrowing the deficit, not ending it, but easing the squeeze. There's also long-term tech substitution. A silver-light solar breakthrough or a battery chemistry shift is unlikely to flip everything in the next couple of years, but over time it's a real variable. Even when tech improves, deployment takes years. Supply response is the other big question. Higher prices can incentivize more production in theory, but in practice mines take time, recycling can only ramp so far, and primary silver mines are relatively rare. For 2026, the supply response is likely limited. And finally, intervention risk, the kill switch topic. If an exchange imposes harsh measures, liquidation-only rules, forced cash settlement, emergency margin policy, it can temporarily cool a rally. It's happened before, and it's always on the list of things that can shock the market short term. Legal or fair, maybe not, but it's happened before, so the risk is always on the table. The difference now is that industrial players are in the mix, not just speculators, so heavy-handed intervention gets harder politically and economically. So where does that leave us? If you're holding physical silver, congrats, you're positioned for what could be a historic run. All the frustration, years of chop, fake breakouts, endless manipulation debates has funneled into this moment. 70, 1.11 is validation, but it's not the finish line. It's a major checkpoint. If you're new or you've been waiting on the sidelines, don't FOMO blindly. Volatility is part of the deal. Sharp pullbacks can happen, and 10 to 15% corrections are normal in a bull market this strong. Those dips are opportunities. 71 can look expensive today, but if the road leads toward 100 or more, a pullback into the mid-60s can be a gift. Positioning physical first coins bars take delivery, especially if your goal is wealth preservation. If you want leverage, miners are the higher risk option. Juniors can move 5 to 1 or 10 to 1 versus silver, but they're volatile and selection matters, balance sheets, costs, and real growth projects. And the allocation question, how much of your net worth comes down to your risk tolerance? Traditional thinking says 1 to 5% in precious metals. Higher conviction goes 10 to 25. Only you can decide. But with everything we've covered, having zero exposure starts to look like a real miss. Zoom out even more and you see the bigger story wealth transfer from paper holders to physical holders, from weak hands to strong hands. From people waiting for confirmation, which is always late, to the ones who positioned early while everyone laughed. At 71.11, the confirmation moment is here. Mainstream attention follows, next major outlets run, segments, social media lights up, and new money pours in. Retail FOMO, institutional catch-up, maybe even an ETF feeding frenzy, but the biggest move usually comes after the crowd arrives. And if the stress escalates, industrials struggling to source metal, registered stocks dropping toward extreme lows, vaults emptying, dealers running dry, and paper contracts leaning into cash settlement, that's when 100 starts to feel cheap. The quiet grind before this, the annoying chop that wore people out, is often the setup phase before the real acceleration. That chop was the shakeout phase, weak hands handing it off to strong hands, retail getting worn down while bigger money quietly builds positions. The market cleared out the tourists before the real run. Enjoy the calm while it lasts, because when the storm hits, availability disappears, and price can go vertical. The banks know it, the commercials know it, the industrial buyers know it. That's why you see desperation in certain corners. They try to steer the narrative, pin the price, and push the timeline back. But they can't beat reality. They can't create silver out of thin air. They might slow the move, but they can't erase it. And today at 70, 1.11, that kill switch idea failed. The paper game lost control. The physical market won. Tomorrow can be higher, next week can be volatile, but the trend stays up. And next year, if the deficit holds and the crowd finally piles in, this turns into a repricing event people study for a long time. So yes, this is your moment. Hold the line. If you're trading futures demand delivery, be the strong hand when weak hands panic on dips, add on weakness, respect the volatility, but don't lose the plot. And don't get complacent, the fight isn't over, it's just moving into a new phase. And to everyone watching, thank you for being part of this movement. While mainstream headlines lag, while banks scramble behind the scenes, while officials pretend everything is fine, you're here learning, questioning, and positioning ahead of the crowd. This isn't just content, it's a community. People who don't blindly accept the official story. People who do the work. People who understand paper isn't the same as real wealth, and that premiums are often the first sign of stress. The biggest wealth transfers happen when most people aren't paying attention. You're not late, you're early. The squeeze the vault, stress the repricing, this is just the beginning. 70, 1.11 is a start, not an ending. If this hit home for you, share it. Tell someone who needs to hear it. The window to position doesn't stay open forever, and the crowd always shows up late. Drop a comment, what's your silver target for 2026, 100, 150 higher? Let's hear it. Stack smart, stay strong. The future is silver.